Welcome to Catalyst. I'm Madison Mills. 30 minutes into your U.S. trading day. Let's get you the three catalysts we're watching this hour. First up, market sell-off gaining steam as stocks test new lows. We'll break down the market action for you. And we bring you an exclusive interview with AMD CEO Lisa Su. You won't want to miss it. Plus, we track the tech trade as Magnificent 7 stocks see their worst start to the year since 2022. We'll get you those details ahead. Half an hour into the start of U.S. trading, let's get you a check on the markets brought to you by Tasty Trade. Let's take a look at the major averages here. You are still seeing significant selling this morning. Now, what's interesting is the S&P 500 has now recovered from its prior low of 55.21. You can see it's just above that at the moment. If it closes below that, that could perhaps be a further bearish signal for the market here. You've also got your tech-heavy names responsible for a large majority of the losses we're seeing today. Your tech-heavy NASDAQ down about 2%. Let's flip it over to the bond market here because we are seeing treasuries catching a bit of a bid this morning. You've got your 10-year staying firmly below that key 4.2 level here. And you've also got that front end of the curve coming in a bit as well. But finally, wanted to take a look at the relationship between treasuries and stock moves because as you can see, treasuries are starting to gain while stocks are falling. And usually this is a relationship that investors can rely on to be able to continue to have a bit of income when it comes to fixed income, but so we've seen that relationship diverging a little bit. And as you can see on this chart here, you are again seeing treasuries gaining while stocks are falling, which is a relationship that is not necessarily beneficial for investors here. Well, to talk more about the selling action that we are seeing today, I want to bring in Adam Johnson. He is the founder and author of bullseyebrief.com. It's a weekly investment letter exploring American ingenuity through actionable stock picks. Adam,
yes, Madison.
Big day to have you back with us here. Lots of selling.
Big, ugly day.
A big, ugly day. How ugly?
There have been a lot of ugly days, and this one's pretty ugly, but I'm actually buying, and I have been buying, and I've got new money coming into the fund this week, and we'll be deploying capital. And what I told those investors is, I think you're actually going to be very happy with the prices that we're paying for some of these stocks. You can only take markets down so long before people start to step in and say, hang on a minute. So the NASDAQ's down, as you just mentioned, 15% from the high. We've got the S&P now trading, call it 10% from the high. And the S&P is now trading at somewhere around 18 times earnings. Well, wait a minute, 18 times earnings when you've got an economy that's growing, where people are full employed, people are spending money, where inflation is coming down, and where earnings are going up 14 to 15%, hang on a minute, 18 times is starting to get pretty attractive, pretty cheap. So there are always two ways to look at these markets. They feel, the drawdowns feel awful in the moment, but they do create opportunity.
But two of the things you just mentioned, inflation coming down, earnings coming up, those are two things that may not stick around if tariffs are as serious and negative as the market is acting like they might
perspective on tariffs. We need to just take a chill pill. Here's why. Net imports are about $1 trillion per year, and you say, oh my gosh, $1 trillion, that's a lot. Yes. Well, GDP, our economy, is 30 trillion. So in other words, net imports are about 3% of GDP. And if we're talking about tariffs that are 10 to 25% of that 3%, we're ultimately talking about an impact on GDP that is less than 1%. Now, am I saying that this is much ado about nothing? No, it's upsetting. When you move around trade flows the way we're talking about, it creates uncertainty. Market hates uncertainty. But I think the actual magnitude of what we're ultimately going to see is a lot less than people expect.
All right. Well, good news for investors then, especially those who are with you and buying. Adam, you're going to stick with us for more here, but we want to get to our next conversation. Goldman Sachs lifting its odds of a U.S. recession to 35%, now expecting 3 rate cuts from the Fed this year amid those concerns about slowing growth. Meantime, the market pricing in at least 3 cuts this year as well, with the first coming in June, according to the CME Fed Watch tool. Here to break down what's next for the central bank, we've got William Dudley. He's the former Federal Reserve Bank of New York president. Thank you so much for being with us this morning here. As we mentioned, we've got recession risks increasing here from Goldman Sachs, from Yardeni Research, other banks lowering their growth forecasts in really quick succession here. To what degree are you concerned about a potential recession?
Well, I'm concerned about higher inflation and slower growth. So that's what's putting the Fed in a very difficult dilemma. they're going to be missing on both sides of their dual mandate objectives. The inflation is going to be too high, and the labor market's going to be on the softer side. I think the key is going to be what happens to the unemployment rate. If the unemployment rate goes up significantly, then the Fed will ultimately cut interest rates. But one thing that people are missing is that it's going to take a very, very slow payroll employment growth to push up the unemployment rate this year, because the labor force is growing much more slowly than it has over the past few years. Virtual shutdown of immigration into this country, deportations, very slow growth of the working age population for people who are born here in the United States. So labor force growth is going to be, 2 or 0.3% after rising 1.5% to 2% over the prior couple of years. So I think people are misunderstanding the fact that a slowing in economic growth isn't necessarily going to lead to rapid Fed rate cuts if the unemployment rate doesn't get pushed up significantly.
So it sounds like you're painting what could potentially be a worst case scenario where we have a stagflationary backdrop, but a Fed that is hamstrung in its ability to cut rates because we may not see unemployment following suit. Is that a correct characterization?
Yeah, I think the problem is that if growth is weak enough, then you don't have to worry about inflation. But if growth is not weak enough, unemployment rate doesn't fall, and then inflation basically hamstrings the Fed. I think what we're going to see from the Fed is the Fed's going to basically be sitting on its hands for quite a while until they see which way we break. I very much disagree with your prior person on the show, because he said that the tariffs are only about net imports, which are $1 trillion. No, they're about gross imports, which are nearly $4 trillion. The tariffs are going on all imports, not net imports. So the impact of the tariffs on imports is going to be much more significant than he said. I would say basically about 4 times the magnitude of what he presumed. The thing that's important about the tariffs is twofold. Number one, the increase in tariffs this time is dramatically bigger than what happened during the first Trump term. First Trump term, tariffs went from 1.5% of imports to 3% of imports. Looks like this time we're going to go from maybe 3% of imports to 15% of imports. So that's a 12 percentage point increase compared to a 1.5 percentage point increase. The second really important difference is inflation that was below 2%. Inflation expectations were really well anchored. We've been running inflation above 2% now for 4 years. This will be the 5th year of inflation above 2%. And there are some signs that inflation expectations may not be quite as well anchored as they were a few months ago.
Bill Dudley, I'm so glad that you and I get a chance to converse. I'm a big fan of yours. You may not be one of mine, but I am a fan of yours. And I would like to just try to figure this thing out, this tariff thing. What if, I'm going to play the devil's advocate, what if where there's some sort of scenario where effectively it's a game of chicken and the other countries say, you know what, we're not going to stick with our 10% tariffs, as an example, on your American cars that come over to Europe. We're going to cut to 2.5%, which is what you charge us. What if this is actually just a giant negotiation and we've gotten so fixated on the worst case scenario that it's not as bad as we actually think?
It's possible that it could go that way, but if you look at the run of news over the last 3 months, every month we've been thinking that the tariff increases are going to be bigger, more persistent. I think the fact that the Trump administration is, taking on Canada is a sign that they're really quite serious about tariffs. What did Canada do to deserve this? We do not have a big immigration problem of people coming over the border from Canada. We don't have a big drug problem of drugs coming over the border from Canada. Canada is integrated with the U.S. economy, and then we're potentially blowing up that integration. So I think that this is not being done in a really careful, thoughtful way. Now, there are times where tariffs make sense when you're trying to protect national security or you're trying to protect industries that are just getting on their feet. But broad-based tariffs against everybody, regardless of how they behaved, that doesn't seem like good policy to me.
And I wonder how you're thinking about the consumer in this environment. We've obviously seen sentiment falling off a cliff, but we've seen over the past couple of years that sentiment and consumer spending don't always align. We're very resilient when it comes to our ability to swipe the credit card, I guess. To what extent do you think that the consumer might start to really be impacted by all of the headlines and concern about tariffs, and that could be a catalyst to push us into a broader slowdown?
Well, I certainly agree that sentiment doesn't is often not a really good predictor of what spending actually turns out to be. I think the problem here, though, is higher prices are going to mean a squeeze on income, especially for low and moderate income households that are already under strain. So I think you're going to see some softening in real consumer spending just because people's dollars won't go as far as they went before because prices will be higher. I mean, just think about the tariffs on cars. I mean, we're probably going to push up car prices by somewhere on the order of 5 to 10 percentage points. So cars are going to become less affordable, so people will buy fewer cars. It was interesting last week, you saw a rally in Hertz stock because the value of their used car inventory is all of a sudden much higher because people are assuming that the tariffs are going to increase the demand for used cars. So you can see these ripple effects through prices that I think are going to lead to weakness in consumer spending. Now, the problem we also have is it's going to be very hard to read the economic data over the next couple of months. Some people are buying now to get ahead of the higher prices that are going to be occurring because of the tariffs. So you could actually see a situation where consumption was pretty strong for a month or two as people basically tried to buy things now at a cheaper price rather than the higher prices that will be in place later.
Right.
We'll know a lot more. We'll know a lot more tomorrow when we see what April 2nd actually turns out to be.
Hopefully we'll get a little bit more clarity tomorrow, at least if you're an investor right now. I've got to ask what you make of the path forward for the Federal Reserve this year. What are you thinking in terms of rate cuts? If you were a voting member, what would you be thinking? And would you agree that inflation is transitory?
Well, it's transitory if it doesn't get into wages. That's the real key thing. And that question is, can the Fed get away with another year of above 2% inflation without inflation expectations becoming unanchored? You know, it's sort of a chicken egg problem. If the Fed stays tough, then inflation expectations won't become unanchored. If the Fed is much more dovish, well, then that increases the risk that people don't think the Fed is credible on inflation. The Fed's been very fortunate and over the last few years that even though we've had bad inflation expectations have stayed well anchored over this period, but you sort of wonder how many years can you keep this going? This will be the 5th year with inflation above the Fed's 2% objective.
All right, Bill Dudley, thank you so much for coming on. Hope to have you back soon. Appreciate it.
Thank you.
For more coverage of the Fed, stay tuned to Yahoo Finance. We'll have a conversation with New York current Fed President John Williams at 3 p.m. Eastern. You won't want to miss it. Adam Johnson of Bullseye is still here with me, and we're going to talk tariffs again. Adam, yeah. I think it's interesting. I wonder if you are familiar with the amount of consumer spend from the likes of Shein, for example, when you say that tariffs are not necessarily a big deal. The majority of the people that I know are getting the majority of their clothing from a company that relies on cheap labor to keep the cost of goods down. How does that not lead to an inflationary backdrop that could potentially tip to a recessionary one?
Oh, there's no question that it's potentially inflationary, but it's a question of magnitude and how much are you really going to move the needle. If you're talking about tariffs of 10 to 25% on, whether you want to go my net imports number or the gross imports number that Bill Dudley just mentioned, that is still ultimately a very small amount.
It's the stacking, though, right? It's kind of the layer cake of tariffs when it comes to steel, aluminum, VAT potentially.
You could argue, but let me tell you something else. So on average, products that come into this country are tariffed. This is over the past 12 months at around 2.7%, right? We put on a 2.7% tariff. Obviously, that's now going up as of Wednesday. When we send products, U.S. exports to various other countries around the world, they face a 6.7% tariff. In other words, other countries are charging us 2.5 times what we charge them. And the whole point of this exercise is to level the playing field. So that's why I say I think ultimately it's a game of chicken. I don't think the end game is to just have higher tariffs on everybody and for everybody to have tariffs on us. I think that President Trump is forcing the hand of the other countries to come meet us where we're charging them, which is obviously quite a bit lower. So that's why I'm not as upset. And I refuse to give in to the fear-mongering that everyone else seems to be giving into at the moment, which is also why markets are down as much as they are.
Right. Well, I think investors would be happy if you end up being right. So
I think I will be right. I think we will look back at this and realize that it was an opportunity to level the playing field, that calmer heads prevailed, that these countries lowered the tariffs they charge on the U.S. goods, and as a result, we don't need to tariff them to the extent that we are planning to.
All right, Adam Johnson, you're going to be with us for the rest of the hour to continue the discussion. We've got all your markets action ahead here on Yahoo Finance, so stick around. You're watching Catalysts. Now time for some of today's trending tickers. You can scan your QR code below on your screen and track the best and worst performing stocks of the day with Yahoo Finance's trending tickers page. First up here, BlackRock CEO Larry Fink assuring investors that economic anxiety will pass in his annual letter, writing that history has proved in the long run we figure things out. Perhaps more notable, Fink didn't say some things. He didn't mention DEI, the company rolling that back earlier this year to a lot of backlash, or his sustainable investing frameworks as well, topics that have often appeared in past letters. The 2025 letter mirroring a broader move away from diversity and climate-conscious investments by financial firms under the Trump administration. Also, firmly left out here. Many of the conversations about tariffs were not included here. Instead, he traded the use of the word tariffs for private markets. This was the huge focus of the note here. And for our audience listening, the good news is you can monitor all of your private market companies on the Yahoo Finance platform now. We have an entire page dedicated to private companies. Of course, you've got your OpenAIs, your SpaceXs on there. So head to the Yahoo Finance platform for that. But interesting to see the focus on private markets, obviously making sense when you're this company, but
well, he runs. I mean, it's the largest money management company in the world, and you and I talk about listed stocks because that's what we can see on our screen. But yeah, there's a whole market out there of private companies. There's a huge market for them. Private equity has been arguably significantly more profitable than the public markets over the past several years. That has started to shift. Less so because there were so many hungry bankers chasing after deals that they compressed the spreads. But yes, the private markets are incredibly compelling. I mean, think of the number of stocks or number of companies now that are worth more than $1 billion. They used to be called unicorns. Wow, it's worth more than $1 billion and it's private. And now I've lost count. There's something like 70, and it's not just $1 billion. It's 10 billion, 20 billion, 32 billion. I mean, it's incredible.
It's incredible, and the valuations just are sky high, especially for a lot of those AI names as well.
Are.
Next up, French regulators hitting Apple with a roughly $162 million fine over privacy changes imposed on app developers. The fine coming just days before President Trump's reciprocal tariffs are set to take effect. Trump has been critical of EU regulators' crackdown on big tech in the past. Of course, it's interesting to see Apple up today, given the selling that we are seeing. What do you make of that, Adam? A little bit of dip buying for the name?
Yeah, I mean, as one should do in any of these high-quality must-own names, I call them core ingenuity, the Magnificent Seven. You call them Magnificent Seven, everybody does. I call them core ingenuity. I think you have to own them. That's the only place you can go where almost to a name, Amazon, Google, Apple, et cetera, Meta, you can actually reach somewhere between 2.3 and 3.3 billion people every day. They are incredibly successful, they're profitable, and they do it at scale, and they continuously find new ways to grow. So I think you have to own those names, and you just buy them when they're down. And that's why I think one of the things that I would hope our viewers, listeners, subscribers, et cetera, one of the things I hope they do with their own money is what's called dollar cost averaging.
Right.
Where every month you just put a little bit more in.
I was going to ask you
and
about that.
You can take it right out of your paycheck and you can put it into an index fund or into a more specific fund if you so choose. But that way you don't have to worry about getting the bottom or overpaying in a rising market. You just continuously put money to work and you build it over time. And all of a sudden you look at your statement 2 years later, 3 years later, 10 years later, and you realize you've built wealth for yourself.
Yeah. But I wonder, would you advise, especially younger people, dollar cost averaging right now to put more of their investments into an index fund tracking the Mag 7 than a broader market ETF?
Buy the Qs. You're going to get overexposure to the Mag 7 because the Mag 7, or core ingenuity, as I like to call it, accounts for something around 45%. These numbers move around, but just because they're so big. So if you buy the triple Qs, which technically is the largest 100 non-financial stocks in the NASDAQ, you are effectively committing half your money, 45%, to the Mag 7, core ingenuity, and then you're getting a wonderful selection, cross-section of all sorts of other type companies as well. I think that's the simplest, best way to do it. It's more volatile than the S&P 500. I run the American Ingenuity Fund. I'm volatile. I'm more volatile than the Qs, but when markets are up and when I have the wind at my back, I generally make more. So I'll lose more in a down market, I'll make more in an up market, and I'm okay with that. I'm a long-term investor. I rarely sell. That's why I'm comfortable playing through some of the pain, like the pain we're having right now.
Right, you've got the iron stomach for it, it sounds like, Adam. You've got it. All right, well, a final company that you need an iron stomach for today, at least, ARM Holdings, reportedly projecting its share of the global data center CPU market will surge this year thanks to a boom in AI demand. Reuters reporting that the chip design company expecting its market share will reach 50%, up from 15% in 2024. I'm fascinated that we're seeing so much selling on this name off of a report like that. Obviously, it's due to the broader market sell-off and not anything specific to them, but you would think that given that market share growth is so significant from 15 to 50%, you'd see a little bit more buying. Well,
I wish that NVIDIA had been allowed to buy them. And this is why NVIDIA wanted to buy them. They're a wonderful company. They're a competitor to NVIDIA. I own NVIDIA. I cannot and will not buy ARM because as someone who runs the American Ingenuity Fund, I don't buy stocks outside the U.S. Even stocks that are listed in the U.S., but if they're domiciled elsewhere, then no, I can't buy it. It's a wonderful company, and it just speaks to the need for greater compute, the ability to compute, to run all the data that we keep talking about day in, day out. Yeah, it's a wonderful company.
Do you feel jealous of the China tech names at this moment? Like a little bit in the quiet moments of your heart?
No, let me just speak to that. No, and I don't mean to sound like a Pollyanna, but I tell you what, you know, we talk about DeepSeek and people say, oh my gosh, this is going to challenge the whole AI ecosystem here in the US. Well, actually, look at how they created DeepSeek. They did it with 2,000 NVIDIA processors. NVIDIA, American company. They also did it with code that was lifted from ChatGPT. Some 40% of the code, by a number of estimates, some 40% of the DeepSeek code was effectively lifted out of ChatGPT. Again, ChatGPT owned by OpenAI, which is 50% owned by Microsoft. Imagine that, another American company. So the Chinese are just doing what they always do, which is rip off American technology, whether it's chips, hardware, or with code, software. And so you say, yeah, but they're going to put all this stuff out for free. It's been ripped off, it's been taken. Okay, fair point, but remember, it's the use cases, it's how you apply that technology. That's where the money is ultimately made. And that's why all these companies are taking AI platforms and then developing the use for them internally. That's proprietary, and that's where the value is because it increases individual companies' productivity.
Right, the increase to productivity and also potentially a step further if you can monetize some of that AI as well.
That's right, and if you can wrap your heads around increased productivity and therefore earnings growth, you're able to look past all the tariff noise and you're able to say, you know what, we should be buying a NASDAQ that's down 15% from the high.
All right, Adam, stick with us for more coverage. We're going to have all of your markets action ahead right here on Yahoo Finance. You're watching Catalysts. Let's get a check in on your major averages here as we still see selling across the board. I want to pull up the major averages for us. So you've got your S&P 500 breaking below that prior low, though hovering around it this morning a bit. It's down about 1%, but the tech-heavy names responsible for the majority of the selling. Your tech-heavy NASDAQ down over 2%. Right now, all Mag 7 members are in the red, though Apple has been waffling to the upside just a bit back and forth this morning. Another name that is breaking down here, we are seeing Palantir entering into the selling with some of those big tech names. And finally, I want to mention all of these chip makers as well, seeing a lot of selling in these names. You've got NVIDIA off about 5%, AMD down nearly a little over 1.5%. But here you see that selling really across the board, including Intel, which had been an outperformer year to date in some of these semiconductor names. Let's head it over to our executive editor, Brian Sozzi, now with an exclusive interview. Hey, Brian.
All right, thanks so much, Maddie. AMD today closed on a $4.9 billion deal to buy AI infrastructure company ZT Systems in a move to bolster its data center and AI offerings. Joining me now for an exclusive here on Yahoo Finance, that is AMD CEO Dr. Lisa Su. Lisa, always nice to get some time with you here. So you had announced this acquisition in August, closing today. How does this change AMD's business moving forward?
Good morning, Brian. It's great to be here with you guys. And today's a fantastic day for AMD. We are super excited to be announcing the close of our acquisition of ZT Systems. ZT is a phenomenal team. And we are now, when you think about AI infrastructure, what we've learned is that customers really need really an end-to-end AI capability, hardware, software, systems, really to get AI in practice as soon as possible. And ZT is a key part of our overall tool chest, and it's super great to have it closed today.
You're making a key distinction, Lisa. You're saying that you may have strategic partners soon for the manufacturing business. Now, you've made it very clear, at least to me and I think investors, you don't want to be out there making your own chips, which is, I think, stands in stark contrast to what we're hearing from Intel, trying to figure out what it's trying to do on that front. Why don't you want to make your own chips?
Well, at the end of the day, Brian, when we look at the ecosystem is we want to be best at what we do, and we are best at being a design company, at being a collaboration partner, at really defining reference designs and capabilities. AI, there is so much need for computing. I think we see that all over the place. You can see all of these new applications coming in. We're designing best of breed, the highest performing chips out there that are going into the largest supercomputers. And we partner really, really well. We partner in silicon manufacturing. With ZT Systems, we're bringing in an incredible team. We're bringing in over 1,000 design engineers who are working hand in hand with our silicon engineers as well as our customers' systems engineers so that we can put together these world-class systems. And yes, we are going to look for a partner for the manufacturing capability because we really do believe manufacturing is best when you can go across a number of different vendors and not just one. Now, from a ZT manufacturing standpoint, we're super excited about the world-class asset we have here. It is U.S. manufacturing at its best. It's AI systems at its best. And so overall, it's just great to be able to bring such a talented team into AMD.
How long do you anticipate for that review process to take, and when do you expect the deal to happen?
So the way to think about it is today we're closing the overall ZT Systems acquisition, so it's coming into AMD. We've been very active with strategic partners. There's a tremendous amount of interest to partner with our ZT manufacturing capability because of its U.S. manufacturing base. And you'll hear much more about that in the coming months as we get through that process. But the main thing is, we now have the ability to offer AI systems and AI solutions sort of end to end. And that's exactly what we want to do. When we look at our next generation roadmaps, we're getting ready to announce our MI350 series that's coming up soon. Next year, we have the MI400 series where we're going to even broader capability. So lots of AI coming from AMD.
When I saw this deal originally, I thought this was Lisa's and AMD's play on AI infrastructure continuing to get built out at a rapid clip. Since last August, we've heard a lot of concern about things slowing. Are you concerned that we're seeing are starting to see a slowdown in AI infrastructure build out?
Brian, I want to be really clear about this. There is no question we are in the very early innings of AI. Now, put some of the noise aside. What we continue to see is more applications, more capability. Enterprises are just at the very early innings of adoption. And frankly, they need more help. And they need more help from folks like ourselves. They need more help on the software application layer. They need more help to really bring sort of the capabilities so that you can see business value. So I am a big believer in this is the very, very early part of AI. The need for compute continues to be immense. We see that throughout all of our customers globally, and we're going to continue to invest strongly in this area because I think this is the single most important technology. I like to say it's the single most important technology of the last 50 years. Certainly what I've seen in my career is I've never seen a technology go as fast in terms of both innovation on every level of hardware, software, models, applications, as well as when you think about adoption. We're still so early in the adoption cycle, and there's so much more we can do.
Why do you think those fears are out there, though, Lisa, that things are starting to slow down? Are you seeing that, I guess, within your MI350 orders or your current AI chips at all?
Look, I think there is a lot of learning that's happening in the market. People are trying to understand, hey, what does it mean when the new model comes in? What does it mean when DeepSeek comes in? What does it mean when the next ChatGPT comes in? And I would say that they're probably a little too short-sighted in the conversation. The long arc of this AI wave is enterprises can do much more, can become much more productive. This is not just about how do we save, some labor costs. I mean, I think that's the small piece of the pie. The large piece is how do we see true business model innovation? How do we build better products? How do we have the ability to solve problems that, frankly, now we can't do with traditional computing that we can now do with AI plus all of the general purpose compute. So I view this as people are just learning as to what the value of the technology is, and we're going to see a lot more benefit as it gets more broadly deployed.
This interview, Lisa, comes at a very interesting time for the world. Lots of focus on tariffs. Now, you get almost 65% plus of your business is international. You contract with TSMC. Help investors understand what's at stake here for the semiconductor industry on the tariff front.
Well, overall, if you look at the baseline is, we do want a more resilient supply chain. Resilient supply chains are important for every industry. They're especially important for the semiconductor industry. We are big supporters of U.S. manufacturing. I think having more U.S. manufacturing is a positive thing. Obviously, when you're running a global company, we're going to be watching the what happens in the tariff situation very closely. And the key is to be agile, to have a very broad supply chain. And we are going to work hard at bringing more manufacturing back to the U.S. as well.
Are investors wrong to think tariffs equal higher prices for semiconductors, and then by extension, PCs are going to cost more, mobile phones are going to cost more?
I do think that there could be some short-term impacts as you think about, what happens in the overall tariff situation. But I don't, I think it's too early to say what the longer-term impacts are. I think we have to look at how things play out over the next, number of months. And, the key is, as I said, we run a global business. We ship all over the world, and we need to continue to have supply chains that, comprehend that as we go forward.
Will your chips cost more?
From what we see today of the current tariffs, obviously we have to see what happens later in the week. I would say there's a relatively smaller impact. We'll have to see what happens as we go through the rest of the week and what happens as we go through the next number of months.
Lisa, this is really, I would say, your second really large acquisition. Of course, you go back to Xilinx in 2022. I believe that was $35 billion. What have these deals helped you do? And then what might be next on your radar?
Brian, I have to say, I'm really proud of our team from a couple of angles. First of all, organic growth is really our mantra. Like, we are a growth company, and from a technology standpoint, that's about putting out great products, ensuring that we keep a very strong roadmap. But we also have an incredibly strong balance sheet, and what that's allowed us to do is make very strategic acquisitions. Very, very happy with our Xilinx acquisition. If I think about what that has added to us in terms of customer set, product capability, skills. 5,000 engineers came into AMD. Now with ZT Systems closing today, another 1,000 extremely skilled engineers coming into AMD. Systems capability, the ability to really give us end-to-end AI. But we've also made a number of other acquisitions in networking, in software, bringing in talent. And it's very important for a company of our size to have the ability to, one, grow so quickly organically, but also layer in additional businesses and additional skills as we go forward. And this is all about ensuring that, we are the leader in high performance and adaptive computing going forward. There's so much need for compute, and we want, AMD has the ability to provide compute across all of the different areas. And I like to say in computing, there is no one size fits all. You need great CPUs, great GPUs, great FPGAs, great networking capability, a great ASIC capability, and the ability to mix and match that. And that is our strategy.
Lastly, Lisa, my contact that I talked to on the ZT deal, they told me that this will allow AMD, this deal, to leapfrog NVIDIA in a few years. Are they totally wrong?
Well, we certainly are looking at how we drive the best in high-performance computing systems. And like I said, Brian, this is all about ensuring that we have all of the pieces, both from a hardware standpoint, lots and lots of investment in software. And ZT is a critical piece in that supply chain and that value chain to give us the systems knowledge. And when we're working with our customers are super excited at doing, a co-development with us and our ZT team as we think about what are we going to do in the future together.
All right, we're going to leave it there. Dr. Lisa Su, AMD CEO, always nice to get some time with you. We'll talk to you soon.
Thank you, Brian.
All right, much more ahead on Yahoo Finance. Do stick around.
U.S. markets back in correction this morning on the final trading day of the first quarter. The tech sector particularly hard hit in this moment, the second worst performing sector year to date. So for more on how investors could navigate this market, we've got Brian Nick, he's New Edge Wealth's head of portfolio strategy, joining us in studio. Brian, great to have you on a very special day filled with selling that we can talk to you about here. Just want to get your sense of the sell-off that we're seeing and how you'd categorize it. Is this giving that we're at a bottom? Is this giving that we're about to enter into a bear market? Where do you see it heading?
So it's not your classic complete risk-off sell-off. You are seeing some of the defensive sectors outperform. You're also seeing energy outperform. Financials sort of outperforming, treading water around flat for the day. It feels more to me like people are shedding what they feel like are the most expensive parts of the portfolio. Seeing some of this in the credit markets too. One of our big calls this year was we wanted to be underweight credit risk in the portfolios. High yield, which had been very expensive. Corporate bonds look very expensive compared to treasuries, for example. And people are starting to sell some of those more expensive positions that might be exposed. Not necessarily the most economically exposed in the case of technology, but the ones that they feel like, I'm not sure what I'm getting when I'm paying this high a price for this asset.
So what do you buy in this environment?
Treasuries are one option, right?
Yeah.
We talk about high quality bonds. If you look at the stock market compared to the bond market, even after the sell-off we've seen, this is one of the most expensive S&P 500 levels we've seen compared to cash, compared to bonds, really since the height of the tech bubble. So investors shouldn't be shy about looking, is my portfolio out of balance? We talk to moderate investors who are maybe more allocated like aggressive investors right now because they've let the equity market sort of take their portfolios in that direction. Rebalancing at this point makes some sense. Even if you feel like you're buying a very defensive asset, at least you're positioned for a slowdown, which may be what we're ended up seeing.
Adam, come into the conversation here, because I know you're buying at these levels.
Yeah, I'm buying. I mean, I look at some of the AI stocks, Celestica as example, 15 times earnings with 30% growth. NVIDIA, cheaper than the S&P 500, 19 times earnings with arguably 50 to 75% growth. To me, that's value. They're growth names that have started to look like value names. Do you find anything else like that, growthy names that are looking like value names today?
So I don't cover individual stocks, but one thing we came into the 2025 kind of feeling like we had gotten a little bit overextended on some of the kind of Mag 7, heavy tech, heavy growth names, obviously anticipating not quite what we've seen in terms of the pullback, but being overweight more kind of value names. Financials is one area of the market that we liked. If we're going to come into sort of a slowdown, that may be one area where we're looking to trim.
Yeah.
But especially if rates are coming down, or at least steadying.
If rates are coming down for bad reasons, it's going to be bad for the banks, right? We're looking at earnings season. One area that we thought was kind of overextended coming into the year was tech ex Mag 7, where it seemed like there was a lot of expectations for earnings growth. Our big theme for the year was great expectations. We thought expectations for earnings were too high. We thought valuations were too high. We thought expectations for what the Fed was going to be able to do with rate cuts were all too high, and maybe investors came in with a little bit of euphoria. So again, anywhere where we can be on the other side of that trade, and it's worked well so far, but at this point we have to reevaluate. Do we want to be in cyclicals with the economy apparently slowing down? Do we want to be in higher growth names that are still in many cases more expensive than the S&P 500. Those are the areas where we're kind of trimming back.
And you said that cyclicals are more at risk if we do enter a recession.
So we're not seeing that today. This is it doesn't feel like a classic recession day, right? Energy stocks are kind of leading the way here. Even with the Dallas Fed manufacturing survey coming out, that's going to be very energy heavy. With a lot of pessimism, you're still seeing energy stocks, you're still seeing commodities up for the day. If you get a genuine cyclical slowdown, that's not going to be the place to be in the market either. It's going to be pure defensives.
I know that a lot of our audience is interested in finding a way to hide out in some of the big tech names, and we just had a chance for our executive editor, Brian Sozzi, to speak with Lisa Su, the CEO over at AMD, about the future of AI. Here's what she had to say.
there is no question we are in the very early innings of AI. Now, put some of the noise aside. So I am a big believer in this is the very, very early part of AI. The need for compute continues to be immense. We see that throughout all of our customers globally, and we're going to continue to invest strongly in this area because I think this is the single most important technology. I like to say it's the single most important technology of the last 50 years.
Do you agree with that from an investment thesis perspective, that long-term AI is the transformative technology to invest in?
So we get asked about thematic investments all the time. People want long-term investments. And the problem is there's a mismatch between what investors will tolerate in the short term in terms of market volatility and what they want to achieve in the long term in terms of their returns. Absolutely, AI is going to be transformative, has been transformative, potential for productivity breakthroughs, handling potentially lower labor force participation, older workforce, and having to find other ways to kind of make up for that problem that we're going to have in the next 10 or 20 years is going to be transformative. A lot of these stocks, I think, when push comes to shove, if and when we do get a genuine slowdown, will do better because they have a secular kind of earnings story, kind of powering their company's sort of the bottom line for revenues, their outlook long term. But in the near term, if they're perceived as sort of this is something that's done well lately, it's been a high momentum trade. Anything that when this hits the wall, anything that's kind of high momentum is going to be suffering. Whether it's a consumer stock, whether it's a bank, whether it's an AI related trade. So in the near term, this could be dicey. Long term, we're big believers, yes.
Yeah, I love that difference between long term expectations versus short-term emotions, right? People are long-term investors until things get rocky and they say, well, I'm not sure. How do you tell your clients how to play through that short-term chop?
Some of it is we try to allocate as much as we can to alternatives, could be private markets. One of the things we had this year, we thought real assets were going to do well. They have done well, but we wanted to play that more in the private side because we know there's a lot of volatility. If you buy things like a commodities fund, a gold fund, gold's obviously been very good, but it can be extremely volatile. Playing more of that on the private side where you have to deploy capital over time slowly and you're getting those returns back over time slowly, it makes more sense to us than something that requires you to stay in the markets through thick and thin, which we know human brains are not necessarily tailor-made to do.
Right, putting a little bit of that emotional EQ into the
Try to put as much of it aside as you possibly can.
Yeah, all right. Thank you so much, Brian. Really appreciate you joining us in studio. Thank you so much. We're going to have all your markets action ahead, so stick around for more. You're watching Catalysts. Elon Musk's xAI just bought his social media company X, according to a post from Musk. This is an all-stock deal that values X at $33 billion, not including debt, and xAI at $80 billion. The new combined entity will be called xAI Holdings. This could be seen as a win for shareholders of the social media company, which has seen a rocky couple of years. Advertisers and users fleeing the platform here. You can see those two valuations compared on screen here. And we still have Adam Johnson with Bullseye here in studio.
You're still stuck with me, Madison.
We still got you. What do you make of this deal? Elon Musk, I mean, he's got a lot on his plate. He's still deal making. He's running Doge.
Boy, he's busy. I think it's a brilliant deal, and I'll tell you why. And I have no vested interest in this. Obviously, you can't own these companies. They're private. But what I think he's really doing is buying access to real-time data at scale, right? Think of all these AI models that have to go back and retroactively try to figure out the whys and connect the dots to come up with their large language models or LLMs. Well, what if you could actually do that with real-time data? What better place to find real-time data about everything from human emotion to news to sports to celebrities to gossip, you name it. What better platform than Twitter? And it's global. So I think it's effectively a way of training his AI models, and he can do it internally and he doesn't have to answer to anyone to do it.
And can the AI model that he potentially works through here beat some of those first movers that have already been in the space that consumers are already used to, given the delay?
Yeah, I don't know where he's going with AI. I don't think anyone knows. He may not even know. Mr. Musk may not even know where he's going with AI. I mean, how can we know? You know, we think we know what's capable of it, and Hollywood has done a wonderful job at sort of tickling our imaginations, but we don't really know where it's going, how far it can go, how it can change life, how it could. We already sort of know how it can improve daily things like making us write smarter emails or better term papers, but we don't really know where it's going in terms of crunching data that might help us customized drugs, as an example.
Right, or how it will potentially protect profit margins and all of those things.
Yeah.
Definitely a lot to unpack. Adam, thank you so much for joining us for the hour.
Thanks for
really
having me,
appreciate it. As always, want to do a quick check on the markets, monitoring that selling before we head to break. You're still looking at losses across the major averages, though not as bad as we saw previously. Your S&P down about 0.8%, recovering from that 1% drop. Your tech-heavy NASDAQ down nearly 2%. Coming up, we've got wealth dedicated to all your personal finance needs. Our very own Julie Hyman will be with you for the hour, so stay tuned for more.